Hundreds of Burger King restaurants in the United States are going to disappear in the months ahead as the company reports the bankruptcy of some of its biggest operators. A series of challenges are threatening its empire as one of the largest fast food chains in America and the world right now. New data reveals that Burger King is falling behind major rivals including McDonald's, Taco Bell, and Wendy's as revenue shrinks and its restaurants continue to lose popularity amongst U.S. consumers. The numbers indicate that the company's problems are getting exponentially worse in 2023. That's why today we're going to expose the factors that are accelerating the demise of this popular brand. But before moving on, please support our work with a thumbs up and don't forget to hit subscribe to stay tuned with our upcoming videos. Not one or two, but three major Burger King operators have filed for bankruptcy so far this year. The biggest franchisees in the state of Ohio, Utah, and Michigan have reported severe cash flow problems and a steep decline in foot traffic, sales volumes, and profits for years. They've been operating several stores at a loss, and about 400 of them are going to close doors for good this year. In addition, the company's executives shuttered 124 underperforming locations between January and May, and another 63 restaurants were eliminated from its portfolio last month, according to reports released by Restaurant Dive. In all, roughly 10% of Burger King's 7,400 locations in America are likely to disappear in 2023, industry estimates reveal. Right now, corporate executives are pressuring collapsing franchisees to sell their stores to other operators instead of closing them, which could result in financial losses to the tune of $300 million. Last month, the company joined a filing alongside various creditors and vendors to force the sale of the remaining units managed by struggling franchisees. Restaurant Business Online reported that Burger King called the operator's reorganization attempt ill-fated and noted it would not move forward with a process that sees the franchisees maintaining ownership of the properties. If they refuse to comply, the brand is planning to sue the operators to recoup an amount of about $10 million in unpaid royalties and ad fees. Restaurant Business International, Burger King's parent company, is at serious risk right now, and Chairman Patrick Doyle says the sale is the only viable path the company would support. The fast food chain depends on its vast network of private franchisees to oversee restaurants across the globe. But in 2023, financial conditions dramatically worsened for many U.S.-based operators, which are now hanging by a thread. It appears that problems between corporate and franchisees continue to rise, with the company's board issuing a note with a very threatening tone earlier this year. Doyle said that underperforming operators will have to leave the system and the company will move on to do something else. There is simply no room for franchisees who are not willing or able to work hard to operate restaurants that are better than the system average over the long term, he stressed. We want our restaurants run by people who are going to run them incredibly well, Doyle said. And if we've got to step in and use our balance sheet or run a few restaurants for a while to make sure they're ultimately winding up in the right hands, we're willing to do that. But there are no shortcuts to us on how you're running the business. We are focused on doing everything right around the Burger King restaurant, and that includes getting the restaurants into the right hands, the executive emphasized. Meanwhile, the brand's CEO, Joshua Kobza, hinted that some franchisees are facing burdens similar to those which drove Tom's King into bankruptcy in March. There are some franchisees who are going through some difficulties, whether it's operational or capital structures, Kobza revealed. Many of these operators aren't set up to be operationally and financially successful over the long run, he said. Restaurant Dive interviewed both franchising and financing experts to discern whether the bankruptcies were harbingers of further troubles for Restaurant Business International and why major competitors haven't faced these problems so far. The biggest issue that I think Burger King has now is that they didn't have the cushion that most of their competitors had from a significant ramp-up and profitability during COVID-19, noted Cardi Davis, partner at C-Squared Advisory Group. That's an investment bank working primarily with franchise businesses. Davis and Brent Elsas, a principal at C-Squared, pointed out that Burger King's U.S. business fell behind the digital capabilities of its rivals prior to the pandemic, leaving the company poorly positioned to capitalize on the boom in online sales in early 2020. I don't think that they had the right marketing and product emphasis at that point in time, Davis explained. I think the brand was sliding into COVID, and they didn't really have a lot of momentum at that point in time. I think other brands were more prepared. And after businesses reopened and inflation started to bite, Burger King saw its margins erode, making it hard for the chain to close the gap with its competitors. One constraint on the company's ability to respond is the structure of its debt, outlined Saeed Dester, an equity research analyst with CFRA Research. According to RBI's earnings release, the chain's adjusted earnings before interest, taxes, depreciation, and amortization has net leverage of 5.1 times, which Dester said was higher than competitors. This means the company has less room to take on the debt needed to finance expensive projects, such as the upgrade of its Burger King U.S. franchise stores as part of its Reclaim the Flame program. The leverage issue is something that Restaurant Brands International has to look at in how to restore the Burger King U.S. In the low interest rate environment, it wouldn't be that big of a disadvantage, but they're doing this in a higher rate environment. It definitely makes the contrast more meaningful for the financials of the company, Dester said. Rising interest rates have stressed many franchisees by tightening credit conditions, while labor costs, supply chain issues, and development costs have all soared. The expert said that a significant but unspecified percentage of franchisees have lost access to development lines of credit and are in some form of technical default, meaning franchisees have exceeded their lease-adjusted leverage ratios or are failing to meet criteria set in other lending covenants, such as EBITDA targets or liquidity requirements. The chain has disclosed plans to spend $150 million on its Reclaim the Flame advertising and digital investment program in order to catch up with other brands. At the same time, it's been applying improvements to creative messaging and ad testing that have helped amplify share of voice and recognition with customers, and also investing in digital menu boards, point-of-sale systems, and printers. On the other hand, franchisees are being forced to spend $250 million to upgrade kitchen equipment, such as toasters, fryers, parking lot repairs, and lighting. Operators that are not complying with the required chances and that are now reporting poor sales performance could face further closures or bankruptcies, Gobser said. In June alone, the 63 closings represented almost 1% of its American footprint. Its new program prioritizes well-situated or high-sales locations, but that also means that Burger King is leaving more distressed franchise units with less support. Only 54% of its stores are participating in its modernization program, leaving about 3,700 stores without the necessary improvements. The fast food chain's U.S. store profitability has been declining for over a decade now. In fact, between 2010 and 2020, Burger King's annual revenues decreased by 36%. In 2010, the brand made an average revenue of $2.5 billion, whereas that number was only $1.9 billion in 2022. Even before the COVID-19 pandemic, Burger King began to see a concerning decline in revenue, For instance, between 2012 to 2013 alone, the company's revenue fell by 41.6%. No wonder why investors have reacted so rapidly to the company's weak quarterly results, sending Restaurant Brands International shares plunging last month as executives warned about the potential impact of inflation. RBI informed shareholders that last quarter's sales slowed by 2% on an annual basis and that the chain's value offers haven't performed as well as anticipated. The buy one, get one for $1 and two for $6 promotions on Whoppers and chicken and fish sandwiches proved to be much less popular than the 2 for $5 deal the chain had in 2020, creating a considerable year-over-year gap in Burger King's earnings. Despite the strategy shifts announced by the chain, those moves didn't seem to be enough to help effectively boost its sales. In June, Burger King's domestic same-store sales grew by 1.1%, but this was a very disappointing gain when compared to its biggest competitor, McDonald's, which grew its sales by 15%. Not to mention, Burger King lost its spot as America's second-largest burger chain. In 2021, Wendy's surpassed Burger King to become the nation's #2 burger chain by sales. According to Technomic data, Wendy's system sales increased by 4.8% last year. Burger King, meanwhile, dropped by 5.4% to $9.6 billion. At that time, Wendy's only had 6,000 restaurants, while Burger King had just over 7,500 U.S. units. Many factors have contributed to its downfall. Since 2019, former CEO Josh Sills said that the chain was struggling with finding the right value narrative for its consumers. He argued that the brand has been choppy in terms of how it addresses value. That's why it launched a $1 Your Way menu in December 2019. But by January 2023, that changed to a $5 Your Way menu. Wendy's, on the other hand, focused on its premium Made to Crave lineup, which included offerings like the Pretzel Bacon Pub Cheeseburger and the Jalapeno Papa Chicken. The menu drove a 10% increase in incremental sales and perhaps illustrates that value actually means innovation and quality. Moreover, Yum! Brands, which operates KFC, Taco Bell, Pizza Hut, and Habit Burger restaurants, reported that net sales rose 7% last year, which indicates that Burger King may lose ground to other big chains. Market and consumer data firm Statista actually shows the top 15 leading fast food restaurant chains in the U.S. by system-wide sales, and these have been difficult years for the whole fast food industry. The newly published data shows that Burger King has become significantly less popular among consumers. Burger King, which held the second spot in the 2019's ranking, is now down to 6th. The number revealed that the company actually has a fairly small market share compared to some of its larger competitors. For example, McDonald's has a global market share of 21.4%, followed by Starbucks, 7.5%, KFC, 2.8%, and Subway, also 2.8%. Burger King lags behind with a 1.2% share of the global fast food market. And while its net profit stood at $1 billion in 2022, McDonald's profits skyrocketed by $7.5 billion, while Wendy's rose to $1.9 billion. Guest satisfaction also dropped by a whopping 40% over the past 6 quarters, as customers complain about worsening quality, the lack of healthier options, and rising menu prices. It's clear that the industry giant is not as financially healthy as we all thought, and if there's something that we learned from the retail apocalypse and the bank collapses of earlier this year, is that there's no company that's too big to fail. A few bad quarters can bring down an empire that's been built over decades. Let's just hope that's not the case with Burger King. Thank you for watching.